Good morning and welcome to the Business Standard Morning Show. I'm Debarghe Sanyal. It's the 28th of September 2023 and here are the questions we'll be answering today. Is inflation hurting FMCG companies' pockets? Can Indian e-gaming survive the tax demand? Is it time to book profit in real estate stocks? And why has the Cauvery water dispute flared up again? FMCG companies are facing a double whammy of sorts. Consumers have turned circumspect due to soaring inflation, and input costs, including that of crude oil, are threatening to cast a long shadow over their profit. And it comes when festival season is just round the corner. So, should FMCG firms be worried? And what may be the way out? In our next report, we bring you the answers.
The post-COVID euphoria among fast-moving consumer good companies is over. The pent-up demand is long gone and consumers are clamping down on discretionary spending thanks to high inflation and growing input prices. This was intensified by global headwinds. More recently, unseasonal rains during the summer and the erratic southwest monsoon have made matters worse. The renewed rise in input prices added to the woes of FMCG companies and slowed the demand across the consumer goods universe, from home appliances to snacks, shampoos, and personal computers. After growing about 25 to 40% year-on-year in the second half of 2020, consumer goods companies are now finding it hard to remain in the black. Data shows that FMCG sale volumes contracted in 2022 largely because of the steep decline in rural demand. It saw a slowdown in urban markets too. Between the March and December quarters of 2022, sales volumes in rural areas shrank by 6 to 10% year-on-year every quarter. Brokerage firm Centrum points out that demand in semi-urban areas was impacted due to inflationary pressure on consumer spending, leading to lower footfall across stores. However, with the festive season round the corner, brands are now bracing themselves for a spike in demand. In a recent interview with Business Standard, Russell Grandinetti of Amazon said that the company is expecting this year's Diwali to be the best in terms of sales. Consumer sentiment for electronic products seems promising. A Counterpoint survey found about 85% of the respondents were interested in purchasing products like air conditioners, refrigerators, laptops, etc., of which smartphones topped the list with more than 50% interested buyers. In fact, most companies had anticipated a quick revival of consumer demand in FY24, with the festive season acting as a prime booster. But now they are switching to a more cautiously optimistic outlook. HUL had reported a meager 3% growth in volumes in Q1 FY24 on a low base, the lowest since June 2022 quarter. While it reported a 7% rise in net profit, its sales grew by 6%. Mumbai-based Marico Limited reported a 3% decline in its operating revenue to Rs 2,477 crore due to a 5% fall in domestic sales as edible oil prices crashed. Dabur India was more resilient. Backed by strong volume growth, Dabur reported an 11% jump in its operating revenue to Rs 3,130 crore. So how exactly will inflation affect the FMCG firms?
So the prices have started cooling and it was like a one-off event. So we continue to track this, that if the vegetable prices are under control or not. The festive season, if you look at the Onam demand and all that, the overall demand has been considerably good. So we expect that for the Diwali as well.
See, we've seen CPI increase while WPI has not, and therefore the upside to pass on price increases is going to be limited for FMCG companies, right? And given the increase in both commodity prices as well as packaging and logistics cost, we will see that there will be pressure on FMCGs. Typically, if you look at any FMCG, about 60 to 70% of its cost is cost of raw material, right? And therefore, to that extent, they are impacted when commodity prices go up. And hence, we will see them unable to pass on that benefit. It's also the festival season. So typically, these are quarters when there is high demand for items which consume a lot of wheat and vegetable fat and sugar, right? And therefore, given that demand is going to be high, we will see limited impact of price escalations from an FMCG standpoint.
And what measures should firms adopt to shield themselves from the possible headwinds?
So for FMCG companies, the three considerable steps that they should be taking for the future. First is the rural focus should be on the forefront, as that is going to help them to drive their volumes back, with a higher focus on the small priced units, which is the small price packs. And then it would be the decrease in the grammage sizes, which is important to keep their EBITDA margins and gross profit margins in check.
I think one of the biggest tools is to look at data and analytics, because they do have access to a lot of data. And one big area where there is saving, like I told you, 60 to 70% of the cost is cost of raw material, right? So can you use AI ML models to drive down the procurement cost? The second area, of course, is to look at the festive season as an opportunity to bundle products, right? So can you come up with a set of offerings which are relevant to consumers during festival season by using bundling as a strategy.
As price rise remains the easiest way to tackle inflation, FMCG companies are steering clear of a knee-jerk reaction. Instead, they are reportedly squeezing margins, prioritizing key stock-keeping units, and rationalizing expenses. While FMCG firms are looking forward to the festive demand, experts point at the need to shift focus to small-priced units and revive rural demand.
While FMCG firms sweat to get their strategies right in the battle against inflation, India's e-gaming industry is fighting for survival, it seems. Facing cumulative GST demands of over 55,000 crore rupees, they are planning to move court. Even as they brace for the impact of the 28% GST regime, these notices, which they say are retrospective, may spell more trouble for them. So, will Indian e-gaming survive the tax blow? Abhijit Kumar has the answer.
India's e-gaming industry heaved a big sigh of relief in August this year, after a prolonged period of uncertainty, when the 51st meeting of the Goods and Services Tax Council announced the levy of a 28% GST on the face value of entry-level bets. Earlier, the GST Council had imposed a uniform 28% tax on the full face value for online gaming and not at the entry level. It means the government will continue levying 28% GST on the face value, but this tax will now be levied only on the initial amount paid on the game and not on the total value of each bet placed. But this relief was fleeting, as one after another these online real money gaming companies started receiving pre-show cause notices. Business Standard recently reported that about 80 online gaming companies are likely to face tax notices for alleged GST evasion of 10,000 to 12,000 crore rupees. Another Business Daily claimed that the Directorate General of GST Intelligence has sent out a dozen pre-show cause notices to online real money gaming companies over alleged GST evasion of about 55,000 crore rupees. Last week, Delta Corp got a tax notice for 11,140 crore rupees along with interest and penalty for allegedly not paying GST on the gross bet value. The company said it will challenge the action and proceedings in court. Fantasy sports platform Dream11 got a GST notice of over 25,000 crore rupees, possibly the largest indirect tax notice served in the country. According to reports, these companies are looking at contesting the GST being applied retrospectively on their revenues prior to the GST Council's decision in July to impose a 28% tax on full face value. One of the largest gaming startups, Dream11, has already moved the Bombay High Court. The company claimed that the notice and investigations give retrospective effect to the amendment which will come into effect from October 1.
Since there are pre-investigation notices, obviously they can be issued at any point of time. But probably the fact that such a huge number of them have been issued at this juncture is probably got to do with the push and pull that is happening with the government or the regulator in terms of the new regime that has been put in place. There is a lot of pushback from the industry. And I think the government is trying to, or the regulator is trying to use some of these mechanisms to try and get the industry fall in line with.
The government has also cautioned these companies on the proposed self-regulatory bodies. It fears that major gaming firms could end up having a dominant presence in these bodies. Sources said that if the Ministry of Electronics and Information Technology finds that SRBs are being backed by big players and that the bodies lack independence, government certification of games will be considered instead of self-regulation.
What the government is trying to ensure that there is equal representation. And there are always chances in a nascent industry like this that such bodies may get influenced or may be, overrepresented by some of the bigger players, and smaller players might not find a voice. But I think rather than government setting up its own self-regulatory body or going in for certification of some of these self-regulatory bodies, it might be better that the government may tweak in or may introduce certain regulations or notifications wherein the membership of the bodies could be further spread out, or representation in the membership could be further spread out.
Experts say that in a tax regime with multiple rates, similar transactions are taxed similarly from a policy perspective, while sin goods are taxed higher. Citing the example of 28% GST on tobacco, they question that should online gaming be classified under the same category. So, what could be the way forward?
You can see the impact across layoffs and certain companies also closing down. What we look forward to obviously is the a relook at the a review to be done within 6 months of implementation. Assuming that October is the start of the new regime, then 6 months, within 6 months of that, or after 6 months, that review would take place.
India's e-gaming industry is at a crossroads, facing both taxation challenges and societal biases. Experts say that the worst affected will be the small and medium gaming companies. While some industry insiders have hopes from a review of the tax imposition in coming months, others believe that same yardstick be applied to the entire gaming sector.
Shares of leading real money gaming firm Delta Corporation recently hit a 52-week low. But the plight of India's real estate was a study in contrast. It is expected to expand to $5.8 trillion by 2047, contributing nearly 16% towards the country's GDP. At the bourses, the gauge tracking related stocks is hovering close to its all-time high level, zooming 50% in 6 months. In our next report, Nikita Vashisht explores investment strategy for the real estate sector.
Shares of real estate players have delivered stellar returns at the bourses over the past few months. Those of Macrotech developers, Mahindra Life Spaces, Prestige Estates, and Brigade Enterprises have surged 30 to 84% over the past 6 months, as against a 16% gain in the benchmark Nifty 50 index. Analysts believe the optimism has been fueled by the hopes that India may see first sign of easy monetary policy in 2024.
That market participants are becoming increasingly confident that the end of the interest rate hike cycle by the RBI is nearing an end, and we may also see a rate cut in 2024. Additionally, the rising affordability, improving rental yields, and increased focus of the government, especially on the rural side, is also aiding the prospects of realty stocks.
Channel checks by Anurag Property Consultants show that the quarterly housing sales hit all-time high in the second quarter of 2023. The top 7 cities, including Mumbai, NCR, Bengaluru and Pune, saw sales of approximately 1,15,100 units during the period, a rise of 36% on year-on-year basis. As per the report, the mid-segment homes dominated new supplies with 31% share. The centre too is focusing on the said segment. Reports suggest it will likely spend 60,000 crore rupees to provide subsidized loans for small urban housing over the next 5 years. Going forward, as analysts expect the Indian real estate sector to grow 12-folds in 25 years, they suggest investors stay invested in the space.
So, given the overall operational performance of the companies that we have seen over the last 1.5 to 2 years, the valuation doesn't seem expensive despite the sharp run-up that we have seen in the stock prices. The valuation has still not reached the euphoria zone, and with the healthy balance sheet that these companies have maintained, the good operational performance is likely to continue with the good demand supply at play. So the investors can continue to hold on to their stocks from next 3 to 5 years point of view.
Thus, double-digit growth in prices, healthy project pipelines, over 85% absorption rate of new launches and peaking of interest rates will likely keep the momentum intact in the pack. On September 28, global cues will guide the markets.
He's making plans for an early retirement. Business Standard.
The resurgence in property demand is indeed good news, not just for the sector but for the country's economy too. Bengaluru was one of the leading cities which saw significant jump in property prices. The average appreciation was an impressive 10% over the past year. But the IT capital of India wore an almost deserted look in the last 2 days. Pro-Kannada outfits and farmer unions had called for a 2-day bandh against the release of 5,000 cusecs of Cauvery water to neighbouring Tamil Nadu for 15 days. But why has this Cauvery dispute flared up again? Nandini Singh explains.
Strike called by pro-Kannada outfits and farmer unions on September 26 brought Bengaluru to a standstill. And now, these groups and opposition BJP have announced yet another bandh on September 29. And this time, it will be statewide. Reports say that the 2 days of bandh may cost the state about 4,000 crore rupees. Cauvery Water Management Authority or CWMA had on August 29 directed the Karnataka government to release 5,000 cusecs of water from Cauvery river per day for 15 days to neighbouring Tamil Nadu. Tamil Nadu wanted more water and had approached the Supreme Court. It had asked the court to direct Karnataka to release 24,000 cusecs of water daily. But the apex court refused to intervene. It said that CWMA and Cauvery Water Regulation Committee or CWRC were meeting and monitoring the water situation every 15 days. The Apex Code said that CWRC had taken into consideration the decreased inflow due to rain shortfall as well as other factors while taking a call on it. The Karnataka government has also decided to approach the Supreme Court against the CWRC order. But meanwhile, farmer bodies, Kannada organizations and opposition parties have hit the streets to protest against the release of water to Tamil Nadu. Karnataka has told the Apex Code that at the reservoir level, which covers a part of the catchment, the shortfall is 53.42%. Why the meager rains? Especially in south interior Karnataka, where the Cauvery river originates. Between June 1 and September 23, the region suffered a deficit rainfall of 27%. Karnataka told the court that the daily flow of 5,000 cusecs of water to Tamil Nadu was against its interest. It claimed that urban areas like Bengaluru were on the brink of a drinking water crisis, while Tamil Nadu needed water for irrigation. On their part, DMK leaders from Tamil Nadu said that Karnataka has consistently rejected suggestions put forth by Tamil Nadu regarding the Cauvery water sharing.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Experts meanwhile suggest that CWMA and other stakeholders should come up with a distress sharing formula to deal with such a situation. Well, that's all for today. For more news and analysis, please log in to business-standard.com. Thanks for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.